Hi everyone, welcome to the channel. In this video, I'm going to talk about the cheapest value stock from the S&P 500 index, which I think will do really well going to 2026. Based upon my analysis, I believe the stock could be 60 to 100% up next year. This year, S&P 500 is 18% up from the year. To date, the Nasdaq is 22% up, and this is the S&P 500 chart. You can see here most of the stocks are actually highly overvalued in terms of the PE basis. There are just few green spots, and these names are even some of the cyclical names or utilities or this kind of companies. Generally, investors and the Wall Street analysts, they like to evaluate the stock based upon the forward PE basis. So let's look this chart in terms of the forward PE. Now it looks little less red, but it's still really red hot. Some of the popular names such as the Apple trading 30 times forward PE, the Amazon 30 times forward PE, the Tesla 218, Palantir almost 200 times, the MasterCard trading 30 times. Some of the names they are associated with AI, they are associated with either related with the growth, or analysts are generally bullish based upon the future expectations. Those names are really expensive going to 2026. There are some stocks that are actually quite down this year, and some of those names, I like this kind of 52-week lows. And if you select these names carefully, generally these stocks go further down at the year end because people like to sell these stocks based upon for the tax loss purposes. But when that is done, when we go to the next year, people like to rotate money from these most expensive, highly overvalued names to the lower valuation names. And during that process, if you select the stock carefully, if you try to avoid the value traps, you are going to make good money. So the GoDaddy is 36% down this year. And I think one of the reasons why it is so much down is stock was actually quite expensive entering to 2025. You can see here it was trading 30 times forward, and the growth was actually still single, higher single digit or mid-teens or somewhere in that range, which is not really sufficient to compensate this kind of expensive valuation. I think that's one of the main reason why stock crashed 36% this year. Another reason I think is this stock is actually kept here in the S&P 500 index in the software infrastructure segment, and some of these software names this year were actually quite down. It could be fear to the AI, it could be several other reasons, could be the valuation. But why I like this stock moving forward is it is actually now came to the reasonable valuation, 16.5 times forward PE. Based upon the free cash flow, the metrics stock is even more cheaper. The balance sheet looks pretty good. There is still some growth. The based upon the PEG ratio, stock is trading less than one, which is really good. And the fundamentals are still intact. And one of the reasons it is sold this year is due to the fear related to the AI. But this business is really, I think it is very hard to disrupt the GoDaddy from the AI because some of the segments could be disrupted, but it has several segments. They are actually quite insulated from the AI. So now let's look the recent earning calls of the GoDaddy, and you can see here the total revenue was 10% up in the last quarter on the year-over-year basis. Similarly, the total bookings they were up 9%. And it has different segment of the businesses, the application and the commerce segment that was 14% up, which is quite good. And the core platform that was 8% up. So uh, what are these segments means? So it has several different types of business, three different types of businesses. The one business is basically helps to maintain the domains for the websites. And the other segments are basically helps to build the website and helps to provide different types of software platforms to the customers. And especially the first segment is the application and the commerce segment that actually provide different applications. The core platform means that is for uh, maintaining and managing their website domain. So their domain business is the core platform that actually generates majority of the revenue. But another two segments are also significant. The next thing you like to check about is always the balance sheet, and you can see they have the cash equivalents of close to 1 billion as of 2025 September. And their debt is 3.8 billion. And they actually increased their guidance for the next quarter. So you can see here they raised their revenue expectations to 4.9 to 4.9593 to 95 billion range, and that is 8% growth year over year. The most important parameter is they expect to make the free cash flow of the 1.6 billion versus 1.4 billion last year. So if they are able to make the 1.6 billion free cash flow, what they can do is they can utilize that free cash flow to share repurchase, and they can also pay the remaining debt. So in terms of balance sheet, I find the company has solid balance sheet when they have a plan to actually repurchase their shares. And when the stock is particularly very cheap, what I like to see is they deploy the free cash flow in a good systematic way. And I think the GoDaddy is deploying that free cash flow in a good way. You can see here this year to date, they actually repurchased 9 million shares, and total amount of the 1.4 billion. And for a company of the size of 117 billion, I think the 1.4 billion repurchase is really good. Now let's look some of the estimates going forward for the 2026. So you can see here the revenue expectation for the 2026 is about 7% and similar for the 2027. So definitely the company is not growing super fast, but I think it is fast enough to avoid the value traps because there is still some growth. And if you look the earning expectations, they are actually expected to grow much more faster than the revenue. So the analysts are expecting to earn $10.3 going to 2027. So when we enter to the 2026, then we start looking for the next 12 months or the following year. And GoDaddy is expected to earn $10.3 for the following year. And if you give the 20 multiple, that the earning estimate, then you get the share price of $200, which is, I think, significantly higher than the $127 of the current share price. And if the multiple further expand when the price momentum catches up, and if it trades 30 times at the end of the next year, 2026, then you get the share price of $300. So if you extrapolate these numbers, the stock is really cheap now, and you can easily make 100 to 200% within a year or two. So for that reason, I really like the stock here. Now let's check the technical analysis. So you can see here the share prices are still up above the 200 SMA in the weekly chart, but they are below the 50 and the 20 SMA. So that means this stock actually was flat for quite some time in more than a year between the 2022 to 20 late 2023. Then it started going up, and it actually went quite up, more than 100%, from the $70 range to the $215. Then it started crashing because it was really overvalued. Now the valuations are good. Still, there is technical support, but still need to work on the technical levels. I think what I want to see in the next few months is start going up and crossing this 130 level or up from there. Then if it breaks out, then I'll add to my position and I'll hold up to 200 to probably somewhere in that range, 200 to $300. So this is my analysis with the GoDaddy. Please let me know what you think in the comment section and subscribe my channel so that you will not miss my next videos.